Hello, everybody. Chad Lubin, Cross Country Mortgage. Hope you had a fantastic weekend. I hope you enjoyed our four-part series on how to win more multiple offers. Today, I wanted to talk about why interest rates are increasing so quickly and what you can do about it. So Lael Brainerd, who is a Federal Reserve Board chairman, spoke last week that they need to aggressively unwind their balance sheet. And what she means by that is the Federal Reserve has been artificially keeping mortgage rates low during COVID by buying mortgage bonds. They should have stopped buying. They're still buying around October, November last year, like they said they were going to, and gradually sell them in the first part of 2022, which they also said they were going to do. Well, they've chose to do the opposite of what they said. Because of the war in Ukraine. I don't know how that factors into our economy so much, but I disagree with their stance. And unfortunately, now they do have to get aggressive in unwinding their balance sheet, and that will lead to higher mortgage rates. And unfortunately, the Fed hasn't been aggressive in their prime rate increases like they said they were going to. They only went up by 0.25%. My opinion, they should have done 0.5 to 0.75. But now they're playing catch up. So they're going to need to be more aggressive. Let's hope they do it in this next Fed meeting. It needs to be 0.5 to 0.75% increases until inflation takes hold. So we are headed for a recession. If you look at these technical signals, there's an inverted bond curve, an inversion of the yield curve is what it's called. And it's when interest rates on treasury bonds, if the shorter rates rise above the longer term rates, that creates an inversion to the bond yield. That's what happened 2 weeks ago. We also have the stock market down by over 10% for the year. That's another signal for a recession coming, and inflation being above 5% in a year. We're way above that. We're like 8%. So one of those three things can signal a recession. All three of those things together certainly signal a recession coming up. So what can we do about it? Well, prices continue to go up. I don't believe that's going to slow down. There's a supply issue. We're over 4 million housing starts behind to just keep up with current demand. So despite what prices do, despite what interest rates do, people have saved a lot of money. People are making a lot of money. They're still going to pay for a new home. Now, some buyers might be removed from the pool because of these higher interest rates, higher prices. Only time will tell. I still think this is a 3 to 5 year inventory issue. So what do I think will happen, and how do we sell around this? You get what you put out. So if you talk about it a lot, if you obsess about it, if you're fearful about it, that will come across to your clients. If you're confident, if you sell what you have, if you make it business as usual, your clients will feel that it's business as usual. So right now we're selling a lot of adjustable rate mortgages. The only good thing to come from a recession is lower interest rates. So you typically see more government stimulus during a recession. I believe that will happen. I believe the Fed will sell their mortgage bonds and then come back in another year or two and buy them all back up again to drop interest rates. So we're recommending a lot of clients to go into adjustable rate mortgages. Let me show you an example I created for you. This is a $550,000 mortgage. One is a 30-year fixed. One is an ARM. It saves you $168 a month. Most people usually make the decision, I'm not going to take the risk of a 30-year fix. It's only $168 a month. Well, what's that $168 do paid towards this mortgage balance at a lower interest rate? That's the fair way to compare two loans. Well, check it out. It's $32,493 over 10 years. So I always tell the clients, that number represents two things. That's your reward for taking a risk. If you do the ARM, I believe we'll be refinancing you within the next 3 years. So I recommend to take that risk. If you choose the 30-year fixed, Mr. or Mrs. Client, that's fine too. This is the price tag of your security for that decision. So you're overpaying by $42,493 over the next 10 years on a loan that I don't believe you'll be in for 3 years. So that's exactly how I say it to the client. Then I show them their risk. your rate can go up by 2% on average. If it went up to 6.75, now keep in mind, you can refinance out of this at any time, but you'd still be ahead by $27,000. In year 12, if it went to 8.75, we definitely would have refinanced you out of this mortgage by this time. But if we didn't, you'd still be ahead. And at the end of year 13, when it goes to its max interest rate that it can go to 9.75, you would break even versus the 30-year fix. So you have about a 12.75 break even. If you know you're going to not be in this mortgage in 12.75 or not be in this home, I can guarantee you that the ARM is a better option for you. So guys, it all comes down to education during this time. Please know I'm here, my team's here to educate your clients with these options, to not allow the fear of inflation grab hold of our clients. It's a time where experience and education matters. Go out there and give your clients the experience and education they deserve. And please know when you send your buyers to me, this is what we go over with them. Thank you for your time. Feel free to call me with any questions, 704-495-1869.